Welcome back to the Deep Dive, where we cut through the noise and get right to the heart of what you need to know. Today, we're taking a deep dive into something that touches nearly every financial future in the U.S., but often feels, well, a bit like a maze: retirement plans. Understanding these isn't just about, parsing financial jargon. It's about making smart choices that can truly shape your financial security down the road, especially given how Congress encourages saving through various tax incentives. Think of this deep dive as your clear map to navigating saving for your golden years, whether you're an employee, running your own business, or maybe just curious about how these powerful financial tools actually work. Before we dive deeper, just a quick reminder that this deep dive is based on material from Farhat lectures. All content, examples, and explanations discussed here are derived from the comprehensive accounting resources at farhatlectures.com. Whether you're an accounting student, CPA candidate, or professional, definitely visit the website for additional practice questions, video lectures, and detailed support to reinforce today's topic. Special thanks to Professor Farhat for providing this valuable material. Okay, let's unpack this. Before we jump into specific plans like 401ks and pensions, what are the fundamental concepts we need to grasp, the real basics to understand how any of these accounts actually function?
That's definitely the right place to start because these core ideas, they really underpin everything else we'll talk about. So the first big one is the idea of a tax-deferred account.
Tax deferred. Okay.
Yeah. Simply put, it means the money you put into the account today isn't taxed right now. Instead, it gets to grow completely free of annual taxes. So any interest, dividends, capital gains inside that account, they aren't taxed year after year. You only pay taxes way down the line when you actually take the money out, typically in retirement.
So the magic is that your money compounds, it grows without the government taking a slice every year until much, much later. That sounds like a huge benefit.
It is. It's incredibly powerful over the long term.
Now, let's talk about how the money actually gets into the account. This distinction seems absolutely critical. Pre-tax versus post-tax contributions. What's that about?
Exactly. This is fundamental. So when we talk about pre-tax contributions, it means the money you invest hasn't been taxed yet. It comes out before taxes are calculated. And this leads to immediate tax savings for you right now. Imagine you earn, say, $3,000, and you decide to put that full amount into a pre-tax retirement account, like a traditional 401k. If your income tax rate is, let's say, 30%, you immediately save $900 in taxes for this year because that $3,000 isn't counted as part of your taxable income right now.
Got it. So an instant tax break.
Precisely. Now, post-tax contributions are, well, the opposite. This is money that has already been taxed before it goes into the retirement account. So using that same $3,000 example, you would already pay taxes on it, say that $900, and then you invest the remaining $2,100.
I see.
So in this scenario, there's no immediate tax break today because you already paid the tax on that income.
Understood. So pre-tax saves you tax now. Post-tax means you paid tax already. Knowing that, what does this mean when you actually retire? Say you're 65, ready to take the money out. How does it play out then?
Right. This is where that early decision really hits home. Generally speaking, if your money went in on a pre-tax basis, then when you withdraw it later, both your original contributions and all the earnings, all the growth that accumulated over potentially decades, are fully taxable as ordinary income.
The whole amount.
The whole amount.
Yeah.
So if that initial $3,000 grew to, let's say, $1 million over your career,
Wow.
that entire $1 million would be subject to income tax when you pull it out.
Okay, that's significant. And what about the post-tax money?
With post-tax money, the original amount you put in, that $2,100 in our example, is typically tax-free when you withdraw it. Why? Because you already paid taxes on it way back when.
Right, makes sense.
And here's where it can get even better. If certain rules are met, like, for instance, if it's in a Roth IRA, which, we can dive into another time,
Okay.
then potentially the earnings on that post-tax money can also be entirely tax-free when you take them out.
Whoa, tax-free growth and tax-free withdrawals.
Potentially, yes. So you can see how deciding when you pay the tax now or later has a massive impact on your actual spendable money in retirement.
That distinction is incredibly important. Okay, let's start looking at the different kinds of plans. We're focusing today mainly on employer-sponsored plans and some options for the self-employed. We mentioned qualified pensions, profit-sharing plans, 401k, 403b, KOG, H, SEP, and simple plans. Quite a list. Let's start with what many consider the classic, qualified pensions.
Right. Qualified pension plans. For a long time, these were kind of the gold standard of Retirement benefits. They offer a guaranteed income stream, like a monthly check for employees once they retire, provided you meet certain requirements, like years of service.
Guaranteed income sounds amazing.
It is. It's a truly valuable benefit because the investment risk is mostly on the employer, not on you, the employee.
Speaking of traditional pensions, they seem pretty rare for new hires these days. But it reminds me, you actually have a story about kind of stumbling into one, right? By accident.
Yeah, it's kind of a funny story, but it really highlights how these systems sometimes work, or used to work. I was teaching just a couple of courses as an adjunct, part-time at a state university. And apparently, without me really paying close attention, if you taught 2 or more courses, you were automatically enrolled in their state pension system.
No way.
Yeah, I signed a mountain of paperwork. You know how it is. Didn't think much of it. Totally forgot about it.
Yeah.
Then, a few years later, I started a full-time job at a community college. Different city, different system. When I was doing my new hire stuff, they told me, oh, just so you know, our pension plan was discontinued for new employees a while back.
Yeah.
I said, okay, fine. I was planning on just using their 403B anyway, which we'll get to.
Right.
But then maybe a couple days later, HR calls me. They say, actually, you do have a pension. I was completely baffled. How could I? I just started.
Huh. What happened?
Turned out I had been grandfathered in to the state retirement system because of those few adjunct courses I taught years before, because both institutions were part of the same state system.
Wow. Pure luck.
Pure luck. So I ended up with this defined benefit pension that most new hires, even then, weren't getting. It really shows that these traditional pensions are, well, mostly a thing of the past for the general workforce. You still see them for, like, police officers, firefighters, government employees, folks who might not have sky-high salaries during their careers, but they get that guaranteed income security in retirement, which is hugely valuable.
That's a great story. So pensions sound fantastic for employees. That security is key. But what makes them so expensive and, well, complicated for companies to offer? Why don't we see them more?
Well, a big part is the cost and the risk, like we mentioned, but also the complexity comes from that word qualified. To get the tax benefits, these plans have to meet a lot of strict IRS requirements.
Okay, what kind of requirements?
First off, companies can't just, hold the pension money in their regular bank account. They must set it aside with an independent trustee.
Why is that?
It's protection for the employees. If the company goes bankrupt or gets sued, that retirement money is separate and safe. The government mandates this to safeguard employee benefits. It's not the company's money anymore. It's held in trust for the employees.
That makes sense. Security again.
Exactly.
Yeah.
Second, the benefits you receive are usually based on formulas, things like how many years you worked there and what your salary was in your last few years. So the company has to predict future salaries and lifespans, which is complex. And beyond that, these qualified plans, and this applies to most of the plans we'll discuss today, not just pensions have to follow specific IRS rules. They must be non-discriminatory.
You meaning?
Meaning they can't unfairly favor the highly paid employees, the owners, or their families. You can't set up a plan where, say, only the CEO gets great benefits.
Okay.
There's also a vesting period. This means you, as an employee, have to work there for a certain number of years, maybe 2, 5, or 7 years, before you fully own the employer's contributions made on your behalf. If you leave before you're vested, you might lose some or all of the employer money.
Ah, so you have to stick around a bit.
Right. It encourages retention, but also protects your right to the funds eventually. And finally, there must be broad participation. The plan has to actually benefit a significant chunk, like at least 70% of the regular, non-highly compensated employees, not just a select few executives.
So these rules aren't just red tape, are they? From an employee's viewpoint, what's the core protection these rules offer for their retirement savings?
That's a really important point. These rules are fundamentally about fairness and security for the employee. They ensure that retirement benefits aren't just perks for the top brass. They guarantee that if a company offers a plan, it has to be offered broadly, managed responsibly, and your right to eventually receive those funds is protected through vesting. It prevents abuse and ensures your long-term financial security is taken seriously.
That makes perfect sense. It's about protecting the average worker's future. So, with all that effort and those rules, what are the big tax incentives? Why do companies go through the trouble of offering qualified plans?
The carrots. For companies, the incentives are pretty significant. First, they get an immediate tax deduction for the contributions they make to the plan. That lowers their taxable income right away.
Okay, tax savings for the company.
Yep. Plus, these contributions generally aren't considered wages for calculating things like Social Security, Medicare, and unemployment taxes, FU-Day and SU-Day. So the employer saves money on payroll taxes, too.
I see. And for the employee?
For employees, the big one we already touched on, those earnings inside the plan are tax deferred. Your money grows year after year without being taxed until you take it out, usually after age 59 and a half. That allows for potentially much, much greater long-term growth.
It's designed as a win-win, tax-wise, which is exactly why the government uses the tax code to encourage these plans.
Understood. Tax benefits all around.
Hmm.
Now, within these qualified plans, how are the contributions actually structured? Are there different ways the money goes in?
Yes, definitely. There are a couple of key distinctions here. Some plans are non-contributory.
Meaning the employee does nothing? Exactly. The employer funds the entire plan. You, the employee, don't have to contribute a single penny out of your paycheck. Think of that J&J example where the wife didn't contribute to her pension.
Nice.
Then there are contributory plans. In these, both you, the employee, and your employer put money in. My own pension plan, for example, requires me to contribute a percentage of my salary, and the state contributes as well.
Okay, so employee input is needed there.
Right. And another really crucial distinction, maybe the most important one regarding risk, is defined contribution versus defined benefit.
I've heard these terms. What's the difference?
In a defined contribution plan, what's known is the amount going in. The contribution is clear, maybe a percentage of your salary or company profits. But the final benefit you get at retirement, that's not guaranteed. It totally depends on how the investments perform over time. You bear the investment risk. Profit-sharing plans, which we'll get to, are usually defined contribution.
So the outcome is uncertain.
Right. With a defined benefit plan, it's the opposite. The final benefit you'll receive in retirement, like that guaranteed monthly check, is spelled out. It's defined, often by a formula. The employer bears the investment risk to make sure there's enough money to pay that promised benefit. Traditional pension plans are the classic example here. Much less risky for you, the employee.
That's a huge difference knowing who's taking the investment gamble. Okay, let's move on then. What about profit-sharing plans? How are they unique, especially for companies?
Profit-sharing plans are a type of defined contribution plan, so the employee bears the investment risk. The key feature is that the company's contribution is usually discretionary. It's often tied directly to how profitable the company was that year.
So if the company does well, employees might get a nice contribution.
Exactly. If they have a great year, they might put a good chunk into the plan for employees. If profits are down, they might contribute less, or maybe even nothing at all.
Flexible for the company, but less predictable for the employee.
Precisely. That flexibility makes them attractive, especially for smaller companies, whose profits might fluctuate. It can also be a good motivator, right? Tying employee retirement benefits directly to the company's success.
Makes sense. Do employees usually contribute too?
Generally, no. Profit sharing is typically funded solely by the employer based on those profits. And if you leave the company, you usually have options. You can take your vested amount as a cash out, which would be taxable income.
Okay.
Or, more commonly, you'd roll it over into an IRA, an individual retirement account, to keep that money growing tax deferred until retirement.
Got it. Now let's talk about the big one, the one almost everyone has heard of. The 401k. Why the weird name, and how does it fit in?
The 401k. Yeah, the name isn't very creative. It's just named after the section of the Internal Revenue Service tax code that authorizes it, Section 401, subsection K.
Okay. Tax code naming.
Yep. It's essentially a type of qualified profit-sharing plan, but the funding mechanism is different. It's primarily funded through your own contributions, the employees. Its biggest draw, and why it's become so incredibly popular, is that your contributions are usually made with pre-tax dollars.
Like we discussed earlier.
Exactly. So if you decide to put, say, $10,000 a year into your 401k, that $10,000 isn't included in your taxable income for that year. If your tax rate is 20%, that's an immediate $2,000 tax saving right there.
That's a clear benefit.
It is. And then like other qualified plans, that $10,000 grows tax deferred until you withdraw it in retirement. There are annual limits on how much you can contribute as an employee. For 2020, for example, is $19,500. Plus, if you're age 50 or over, you can often make additional catch-up contributions, maybe another $6,500 or so.
To help people boost savings later in their career.
Right. And a huge feature of many 401ks is the employer match. Many companies will match your contributions up to a certain percentage. My wife's company, for instance, matches dollar for dollar up to 5% of her salary.
That's basically free money.
It absolutely is. It's one of the best returns you can get on your money. There's also an overall limit for the combined employee and employer contributions in a year, which was around $57,000 back in 2020. If you go over, the excess has to be returned.
Okay. And do 401ks have to follow those same fairness rules as pensions?
Yes, they do. Because they're qualified plans, they generally have to meet those non-discrimination rules to ensure they benefit a broad range of employees, not just the highly compensated ones.
Okay. And what about the 403b? I hear that mentioned sometimes in the same breath as the 401k.
Right, the 403b, think of it as the 401k's cousin. It's very, very similar in structure and benefits, pre-tax contributions, tax-deferred growth, contribution limits, potential employer match. The main difference is who can offer it. 403b plans are specifically available for employees of public schools, universities, colleges, and certain nonprofit, tax-exempt organizations like hospitals or charities.
So same concept, different name, different eligible employers?
Exactly. If you work for a school or nonprofit, you likely have a 403b instead of a 401k.
Let's run a quick example for a 401k contribution. Say someone earns $80,000 a year and decides to contribute 3% of their salary to their 401k. How does that actually show up, like on their pay stub or tax forms?
Okay, good example. 3% of $80,000 is $2,400 for the year. Since this is typically a pre-tax contribution, their employer would deduct that $2,400 from their gross pay before calculating federal income tax.
So it reduces their taxable income immediately.
Right. Their taxable income reported for federal income tax purposes, like in Box 1 of their W-2 form, would effectively be $77,600. $80,000 minus $2,400, not the full $80,000. That's where the immediate tax saving happens.
But does it reduce all taxes?
Good question. No. While it reduces your income tax, that full $80,000 is usually still subject to Social Security and Medicare taxes, FICA taxes. Those are typically calculated on the gross amount before the 401k deduction. The amount contributed, that $2,400, would usually be reported in Box 12 of the W-2 form, often with a code like D.
Got it. Reduces income tax, not payroll taxes. Now, what about taking money out early? Can you just dip into your 401k if you need cash?
Generally, no, not without consequences. The whole point is long-term retirement saving. So if you take money out before you reach age 59 and a half, you'll typically face a penalty.
A penalty? How much?
Usually it's a 10% early withdrawal penalty slapped on top of the regular income tax you'll owe on the amount you withdraw. So it can be quite costly.
Ouch. Are there any exceptions?
Yes, there are some specific exceptions where you might avoid the 10% penalty. Things like becoming totally and permanently disabled if you pass away, and it goes to your beneficiaries, sometimes if you leave your job after age 55, or if the plan itself is terminated. There are also provisions for hardship withdrawals under very specific limited circumstances, like major medical expenses or preventing eviction. And sometimes during big national crises like the housing crash in 07-08 or more recently with COVID, Congress has temporarily relaxed the rules or waived the penalty for certain withdrawals, but those are exceptions, not the norm.
Okay, so plan on leaving it there until retirement, if you can. Now, what about people who work for themselves? Entrepreneurs, freelancers, small business owners. They don't have a big company offering a 401k. Are there good options for them?
Absolutely. This is a really important area. Self-employed individuals and small business owners have several good options. One is the KEOGH plan, sometimes called an HR-10 plan.
KEOGH.
These are specifically designed for self-employed people and unincorporated businesses, like sole proprietors or partnerships. They function much like other qualified plans, allowing you to make tax-deductible contributions to save for your own retirement.
Are the contribution limits similar to 401ks?
Yes, they are subject to similar overall dollar limits, like that $57,000 we mentioned for 2020. However, the percentage limit is based on your earned income from self-employment. And here's where it gets a little tricky. For contribution purposes, your earned income is calculated after deducting 1/2 of your self-employment taxes and after deducting the KEOG contribution itself.
Whoa, wait. You deduct the contribution to calculate the income the contribution is based on. That sounds circular.
It is a bit circular. It requires a specific calculation, often simplified as contributing up to 20% of your net self-employment income before the KEOGH deduction, which works out mathematically to be 25% of the income after the deduction.
Okay, that sounds like something you might want help with, maybe from a tax pro.
Definitely. It's easy to get wrong. For example, if your net income after the self-employment tax adjustment is $60,000, the maximum KEOGH contribution isn't $15,000, 25% of $60K. It's actually $12,000 because $12,000 is 25% of $48,000. $60,000 minus the $12,000 contribution.
Okay, I think I follow. It's capped at the lower of that percentage or the overall dollar limit, like $57K.
Exactly. And there's also a cap on the amount of earned income that can even be considered for the calculation, around $285,000 back then, which correlates back to that max $57,000 contribution, 20% of $285K.
Got it. So QOG is a powerful tool for the self-employed, but requires careful calculation. What about SEP and simple plans? Are they really simple?
They're generally designed to be simply to set up and administer, especially compared to a full-blown 401k or pension, making them attractive for small businesses. Let's compare them. SIP stands for Simplified Employee Pension. It's often used by very small businesses or even just self-employed individuals with no employees. My brother, who's self-employed, has a SEP IRA for himself. Simple stands for Savings Incentive Match Plan for employees. This one is specifically for companies with 100 or fewer employees that maybe don't offer other qualified plans like a 401k or pension.
Okay, S for potentially just one person? Simple for small companies under 100. How do they work?
Both involve setting up individual retirement arrangements, or IRAs, for the owner and any eligible employees. They function similarly to traditional IRAs or 401ks in the sense that contributions are typically pre-tax.
So tax deduction now.
Right, and the money grows tax-deferred until you take it out, usually starting at age 59 and a half, at which point withdrawals are taxed as ordinary income.
Okay, similar core benefits. How do the contributions differ between SEP and simple?
This is a key difference. With a SEP IRA, only the employer makes contributions. The employee doesn't contribute directly from their paycheck. The employer can decide each year how much to contribute, from 0 up to 25% of the employee's compensation, but they must contribute the same percentage to all eligible employees, including themselves if they're an owner-employee.
So employer only, uniform percentage. What about simple?
Simple IRAs involve both employee and employer contributions, making them feel a bit more like a 401k. The employee can choose to contribute a certain amount from their paycheck, up to a limit, $13,500 in 2020, plus a $3,000 catch-up if over 50. Then, the employer must contribute, but they have two options. They can make a non-elective contribution of 2% of compensation to all eligible employees, whether the employee contributes or not.
Okay, 2% for everyone.
Or they can choose to match the employee's contributions, typically dollar for dollar up to 3% of the employee's compensation. But with this matching option, they only contribute if the employee also contributes.
I see. So simple has employee contributions and a required employer piece, either a flat 2% or a 3% match. Are the eligibility rules also simple?
Relatively, yes.
Hmm.
For a SEP, an employee generally becomes eligible if they've worked for the company in 3 of the last 5 years and earned at least a small amount, like $600 in a year. For a simple IRA, the rules are often based on earning at least $5,000 in any 2 preceding years and being expected to earn at least $5,000 in the current year. Sometimes there's an age requirement, like 21. They're designed to be fairly easy to meet for regular employees.
And the max contribution overall, still capped.
Yes, the overall combined limit, similar to 401k and QOGH, applied, meaning the total going into any one person's account from all sources in a year couldn't exceed that maximum, like $57,000 benchmark.
Okay. Any other quirks with simple plans?
One specific rule for simple IRAs is a slightly stricter early withdrawal penalty. Normally, the 10% penalty applies before age 59 and a half. But with a simple IRA, if you take money out within the first 2 years of participating in the plan, the penalty jumps to 25%, even if you were over 59 and a half. After 2 years, it drops back to the standard rules.
Wow, 25% penalty, so definitely wait 2 years if you're in a simple.
Yeah, it's designed to encourage longer-term participation right from the start.
Okay. Whew. So what did this all mean for your financial future listening up there? We've covered a ton of ground today. We went from basic tax ideas like pre-tax versus post-tax, tax deferral, all the way through qualified pensions, profit sharing, 401ks, 403bs, QOGH for the self-employed, and the simpler SEP and simple plans.
It's a lot, I know. But the key takeaway, I think, is this. Really understanding the differences between these plans is crucial. Is it pre-tax or post-tax money going in? That affects your taxes now. Is it defined contribution where you bear the risk or defined benefit where the employer does? Is it funded just by the employer, or do you need to contribute too, maybe get a match?
Right.
These nuances really impact your current tax situation, how much you need to save, and ultimately the size and, importantly, the taxability of your income stream when you actually retire. And as we've seen, there's really no single bust plan. It truly depends on your individual circumstances, where you work, or if you work for yourself, and what your long-term financial goals are.
That's a really powerful summary. It's not just about having a plan, but understanding your plan. So here's a final thought for you, our listener. Knowing what you now know about these different rules, the pre-tax, post-tax impact, the vesting, the contribution types, even that story of an accidental pension, what's one question you plan to ask? Maybe ask your employer or your HR department or perhaps a financial advisor about your specific retirement plan options. We really hope this deep dive has given you a stronger foundation to ask those informed questions and take more active control of planning your financial future. And remember, if you want to dig even deeper into the details or practice with examples, check out the resources over at farhatlectures.com. Until next time, keep digging deeper.